In this video, we'll calculate the direct labor variances. We've already used this flowchart to calculate the direct material variances in a previous video. The process for calculating the direct labor variances is exactly the same. Similar to what we did for the direct material variances, we're going to separate the price variance from the quantity variance. Let's look at how direct labor variances are calculated using the same flowchart, starting with the price variance. On the left side of the flowchart, we take the actual price per hour of direct labor, which is often called the actual rate, multiplied by the actual total quantity of direct labor hours to determine the total cost based on the actual price paid to labor. On the right side, we take the standard price per direct labor hour, often called the standard rate, multiplied by the actual total quantity of direct labor hours to determine the total cost based on the standard price per hour. The difference between these two totals? It's going to be equal to the total price variance for direct labor. Let's use an example to demonstrate the direct labor price variance calculation. Kira Inc.'s standards are as follows for direct labor. Standard price, $18.50 per direct labor hour. Standard quantity, 4 direct labor hours. At the end of the year, Kira's actuals are as follows. Actual price, $18.20 per hour. Actual quantity used, 4.25 direct labor hours per unit. Budgeted quantity was 8,000 units, and the actual quantity produced is 8,300 units. We'll now use the relevant information to calculate the direct labor price variance. Using our flowchart, we have the actual price, denoted as AP, of $18.20 per hour. Note that this is sometimes denoted as AR, actual rate, but it means the same thing. We also have the standard price, denoted as SP, $18.50 per hour. This also is denoted sometimes as SR, standard rate, but again, it means the exact same thing. I prefer to keep it consistent with the direct material variance calculations, just to make it easier to remember. The actual total quantity has to be calculated by multiplying the total actual units produced by the actual quantity in hours used per unit. This is referring to the actual direct labor hours used per unit, sometimes denoted as AH for actual hours. In this case, we would take 8,300 units actually produced and multiply it by 4.25 hours per unit, which is the actual direct labor hours used to produce one unit. 8,300 units multiplied by 4.25 hours is equal to 35,275 hours. We now have all the information necessary to calculate the direct labor price variance. Actual price is $18.20 per hour. Standard price is $18.50 per hour. Actual quantity in hours, 35,275 hours. Now we do the multiplication indicated. Actual price of $18.20 per hour multiplied by the quantity of 35,275 hours is equal to $642,005. Perfect. This is the total actual cost of direct labor for the period. We can now do the multiplication on the other side. Standard price of $18.50 per hour multiplied by the actual quantity, 35,275 hours, is equal to $652,588. Wow. It's actually equal to $652,587.50, but I've rounded the amount to the nearest dollar. Now that we have the two totals, we can determine the difference in order to calculate the variance. The difference between $642,005 and $652,588 is $10,583. So, is this variance favorable or unfavorable? To determine that, we only have to look at the diamond at the top. The actual price is $18.20 per hour, and the standard price, $18.50 per hour. Did we do a good job controlling our labor rates, which would make it a favorable variance, or did we do a poor job controlling the labor rates, in which case the variance is going to be unfavorable? The actual rate is lower than the standard rate, so we did a good job in controlling our labor rates, and therefore the $10,583 is a favorable variance, denoted with an F. Makes sense. Spending less than we planned indicates that management actually controlled their labor rates to meet and exceed their goal of $18.50 per direct labor hour. The flowchart for calculating the direct labor price variance is easy to follow. We can therefore use it to develop the direct labor quantity variance. First, on the left side of the flowchart, we have the total actual quantity used in production. Note that this is always identical to the total actual quantity we calculated for the price variance. In addition, note that the standard price for the price variance is always identical to the standard price for the quantity variance. This means that the calculation on the right side of the price variance is identical to the calculation on the left side of the quantity variance, which is, of course, the total actual quantity multiplied by the standard price per hour to determine the total cost. On the right side, we take the total standard quantity at the actual level of production and multiply it by the standard price per unit. That determines the total standard cost. If we then compare the two totals, we can determine the quantity variance. Let's return to the example of Kira Inc. and apply it to the direct labor quantity variance. Using the price variance that we already calculated, we know that the standard price per hour is $18.50, so we can transfer that to the quantity variance. In addition, because the actual quantity is always the same, we can transfer the actual quantity, 35,275 hours. We only need the total standard quantity, for which we have a formula, actual units produced multiplied by the standard quantity per unit, and that standard quantity per unit is the standard direct labor hours per unit. This calculation determines how many total hours we should have used if we had kept to the standard hours per unit. For Kira Inc., it's calculated as 8,300 actual units produced multiplied by the 4 hours per unit, the standard direct labor hours per unit. 8,300 multiplied by 4 hours is equal to 33,200 hours. This is the standard quantity of direct labor hours we expected to use at the actual level of production. We now have everything we need to calculate the quantity variance. Looking at the left side, actual quantity of 35,275 hours multiplied by $18.50 per hour, standard price, is equal to 652,588, rounded to the nearest dollar. It's no surprise that this amount is exactly the same for the price variance as it is for the quantity variance. It always should be. Now, looking at the right side of the flowchart, standard quantity of 33,200 hours multiplied by the standard price of $18.50 per hour is equal to $614,200, which is the total cost at the standard price for direct labor hours. Now we subtract the two numbers to determine the variance. The difference between $652,588 and $614,200 is $38,388. This is the direct labor quantity variance. So, is this variance favorable or unfavorable? To determine that, always look at the diamond on the top. The actual quantity used in production is 35,275 hours, and the standard quantity we expected to use, 33,200 hours. Did we do a good job controlling our use of labor, which would make it a favorable variance? Or did we do a poor job controlling our use of labor, in which case the variance is unfavorable? Well, the actual hours used is more than the expected standard hours, so we did a poor job controlling our use of labor, and therefore the $38,388 variance is unfavorable, denoted with a U. Makes sense. Using more hours of labor than we planned indicates that management is unable to control their use of their workers, so they did worse than the standard expected. Can we use these two flowcharts to calculate the total direct labor variance? And the answer is, of course we can. Total direct labor variance is equal to the direct labor price variance plus the direct labor quantity variance. We can therefore apply this to our flowchart. We calculate the total variance as the price variance of $10,583 favorable plus the quantity variance of $38,388 unfavorable. Since the two variances are moving in opposite directions, we have to deduct the smaller number from the larger number, which is $38,388 of unfavorable less $10,583 favorable, which is equal to the total direct labor variance of $27,805 unfavorable. We have now used the flowchart to calculate the direct labor price variance, the direct labor quantity variance, and the total direct labor variance. What now? We have to determine the causes of the variance. Recall that all variances which are material, meaning that they are significant and have the capacity to affect the decisions of management, have to be investigated. For direct labor price variances, the unfavorable variance may be due to paying higher wages than estimated, which must be discussed with the manager who is in charge of hiring workers. Variances may also be due to a misallocation of workers, either using less experienced workers or using skilled workers when it's unnecessary to do so. In this case, discussions with the production department, who are responsible for assigning workers to tasks, is in order. For direct labor quantity variances, management should speak to the production department. These variances may be due to poor training, worker fatigue, or machinery that is not working properly, slowing the productivity of the workers. Another factor may be poor quality material, causing workers to spend more time on each product, or reworking the product due to quality issues. In this case, the purchasing department must be spoken to instead of production. Regardless, both variances, if they are material, must be investigated. That's it for the direct labor variances, how they're calculated, and what may be the causes of those variances. Thanks so much for watching.